Welcome back. Now, creating wealth has long been the catchphrase of the markets investor, but following the global economic downturn, the trend has now gone towards savings. Investing in the markets has become quite intimidating, but Franco Busetti, who's the author of The Effective Investor, says he can make it easier for us. Thank you very much for coming through. What do you make of the current investment climate, and how can we navigate the terrain, especially as novice investors?
Well, I think in a word, one could describe the climate as uncertain. This uncertainty brings with it opportunities, but also risks. The opportunities are that people are nervous. The psychology is quite tetchy, so in a sense one can find mispricings and take advantage of them. The risks are that you're never certain at a time like this. For example, we believe our market is fairly valued at this stage, so over the long term we'd expect reasonably good returns. But in the short term the risk is that the market may become cheaper.
All right, now there's a huge distinction between investment and also short-term trading. And I think for people who are looking for sustainability, the question is, how do I make sure there's an investment, there's value in what I do?
Take a long-term view, that's the short answer. Investing is by its nature long-term. Returns come from various sources. Obviously over the long term, price appreciation is what you're after. Price appreciation is driven by earnings growth in, for example, the shares you buy. In fact, where earnings go, price follows after time. But you also have dividends, and the compounding of dividends is a huge component of returns. So that's what you gain over the long term. Over the short term, you don't have time for earnings to change. You don't really have dividends compounding. So you're basically looking for price changes which are driven by sentiment. Trying to guess them is an impossible task to do sustainably, and therefore you have a problem.
Now, I know your book is quite comprehensive when I look at it. I mean, quite a lot of pages. But what you've done is you've broken down the psychology of the investor and then the various techniques that investor should employ in navigating this market. Could you sum it up for us? What kind of mentality ought you to have?
It's a very wide field. I mean, the psychology is inordinately important in markets. In fact, I think it was Isaac Newton who said they had a big bubble there in the 1700s, and he said, look, I can calculate the motion of the heavenly bodies, but I have no clue about the lunacy of investors. We devoted a whole chapter to that for the simple reason that it is so important. I can't go through all the aberrations, but they'll all strike a chord with readers. I can mention one or two. One of the predominant ones is over-optimism and overconfidence, and that leads to nasty surprises. That leads to overtrading, and overtrading leads to poorer returns. In fact, there was a very interesting study done where they found gender differences, where in fact women were found to be less overconfident than men, traded less, and had better returns.
Isn't that a problem? We're told that we're too careful, we're too cautious, we should be risk takers, because with big risk come big returns.
One can minimize risk. There are many ways to do that. The three main ways: diversify your portfolio, use time diversification, in other words, be in the market for a long time, and again, try and just generally be cautious.
Okay, now this is really about navigating the local market, Vikas Marais, and we've seen a return to equities globally, and the JSE's been doing fairly well, but the JSE is up against major markets, the Chinas, the Indias, and many people are saying, shouldn't the novice investor be braver in going into these new frontiers?
I think being brave is not a good idea in investment markets. What you should be, though, is you should be calm. So don't panic, I think, is one of the big things in terms of the psychology. And the thing I think to keep in mind is that things do return to normal. When things are going so well that it can't be sustained, be really careful, because things will return to normal. But when things are a bit let's say volatile, and when markets have come down, also remember that things will return to normal. So actually continue with your long-term strategic investment plan is probably the best advice.
Okay, final question to you, Franco. We're beginning to see regulation being the catchphrase internationally. We know that here the technology at the JSE and other regulatory frameworks creates a situation where the member and the investor is protected. But what kind of information should traders be giving us as novice investors, in order to help us understand what they're doing? Because a lot of the time, the stockbrokers are making decisions on our behalf, and we just have to trust them, these fund managers?
Look, I'm no expert on regulation per se, but what I think advisors should do more of is discuss the aspects of risk with clients, what it means, how to cater for it, and also the psychology, so that investors understand themselves better. I think that's quite critical.
Thank you very much for your time, Franco Busetti, the author of this book, The Effective Investor. So if you're a little bit nervous and you want to be calm, as Vickers says, this is the book to read. You've been watching Business AM. I thank you very much for coming through. Thank you, Vickers Moret, for being our guest host from Stratasys. After the break, we're previewing the European Trading Day. We're back at 8:30 a.m. Central African Time as the JSE opens with Open Exchange. Join us then. Cheers.